you remember the panic waves that plunged Wall Street into chaos in September 2008? Well, several indicators are signaling that it's happening all over again. And market strategists are saying that once selling starts to spiral out of control, it's gonna be nearly impossible to stop it. On Monday, the Dow Jones Industrial fell to the lowest level since June 2020, marking the seventh biggest single-day decline in history. The drop was actually larger than anything we witnessed back in 2008. It was fueled by a sudden shift in sentiment as investors got extremely disappointed by the monthly inflation report because it showed that the recent efforts to tame inflation growth are not working, and that means more rate hikes are coming. Major market players are alerting us that we haven't hit bottom yet, and a much more dramatic stock market crash is about to occur. That's what we're going to expose today. But before we continue, we would like to give a special shout out to our sponsors. Even after the dust has started to settle, Goldman Sachs still reports that a typical stock-heavy portfolio is expected to flatline this year at best. As a result, 8 in 10 ultra-high net worth figures are investing outside the stock market into alternative assets, things with a low correlation to stocks, like contemporary art. The numbers show that contemporary art has a negative 0.04 correlation to developed market equities, basically major stocks, and less than 0.3 correlation to other asset classes. For reference, hedge funds have a 0.77 correlation to developed equities, meaning they're far more correlated. Because the art market behaves differently, even Morgan Stanley specifically recommended it, saying, investment-grade art has a low correlation to other major asset classes and often experiences lower price volatility. No wonder masterworks are seeing increased demand, because they help investors get contemporary art into their portfolios by removing the multi-million-dollar price tag. And since having started out in 2017, they have since been featured on TechCrunch, CNBC, and Forbes, among others. It basically works like this. Masterworks buys up an expensive art piece, then breaks it up into smaller, affordable shares, which you can then invest in on their platform. This is actual fine art from guys like Picasso and Banksy, not NFTs. Masterworks has over 500,000 users, and to date they've sold 6 paintings for an average net return of 29%. Of course, past performance is no guarantee of future results, but that's still pretty incredible. Demand is high with the stock market still in turmoil, and there is a wait list. But my viewers can skip it just by clicking the link in the description. Thank you for watching. Alright, now let's get back to the ongoing stock market crash. Wall Street is in a very sour mood right now. Another mass sell-off took place on Tuesday. Things are starting to look quite frightening. The Dow went on a free fall yesterday, and other indexes followed suit. In a single day, the Dow slid 1,276 points, losing 3.94%, and closing at 31,104.97. The S&P 500 and the Nasdaq Composite actually performed even worse, plunging 4.32% and 5.16% respectively. All 11 sectors of the S&P 500 recorded losses, with only 5 stocks finishing in positive territory. Tech stocks suffered the most, with Facebook parent Meta skidding 9.4% and chip giant Nvidia shedding 9.5%. The sharp declines marked the worst day for stocks since the burst of the health crisis. Of course, a single bad day doesn't make a full-blown meltdown, but it might indicate that one is rapidly approaching. When we compare the current behavior of the stock market to how it behaved just prior to the brutal crash of 2008, the similarities are astounding. God help us all, wrote one online commentator, who compared recent movements of the stock market to those that preceded the darkest days of the global financial crisis. Another chart released by the research group Sentiment Trader shows that institutional traders bought $8.1 billion worth of put options last week, which is 300% more extreme than in 2008. The purchase of a put option gives the holder the right to sell an asset at a specified date and is generally interpreted as a negative sentiment about the future value of the underlying stock, researchers explained. The data is mind-blowing. In 22 years of doing this, no chart stands out like this one, the company noted. The collapse was mostly driven by worries about inflation. Since the start of the year, stock valuations have been in a cycle of ingenuous hope. They fall when inflationary pressures persist, then turn higher as investors believe the Fed may ease up on rates, and then drop again when new data comes about undercutting all those hopes. Inflation figures for the month of August were so much worse than expected that at this point, traders see a 1 in 5 chance for a full percentage point next week. That would be quadruple the usual move. And no one in the futures market was predicting such a hike just a day earlier. According to the CME Group, traders now see a better than 60% likelihood the Fed will pull its federal funds rate all the way up to a range of 4.25% to 4.5%. A day earlier, they saw less than a 17% chance of such a high rate. Amid such a risky environment, it certainly won't take much to spark a massive rush for the exits, considering that a bad inflation reading, which, by the way, has been much lower than June's 9.1% CPI, was enough to cause this sort of stampede. If a major black swan event happens, the carnage can turn out to be a whole lot worse. In fact, a top executive at the world's largest hedge fund is arguing that this is just the beginning of the pain for investors. During an interview at the SALT Hedge Fund Conference in New York, Greg Jensen, co-chief investment officer of Bridgewater Associates, said that the stock market hasn't fully priced in a recession just yet, and that the U.S. is at the center of a global bubble that is about to burst. The co-CIO noted that investors are overestimating the extent of policy tightening by the Fed, and that means asset prices will continue to fall. I think the biggest mistake right now is the belief we're going to return to, essentially, prices similar to the pre-COVID period, Jensen stressed. His comments echoed previous statements from his fellow chief investment officer Bob Prince, who told Bloomberg earlier this year that the U.S. is on the brink of a devastating stagflationary crisis, a toxic economic combination of low growth and high inflation, and that investors weren't properly accounting for the impact of a new economic downturn. We continue to believe markets underappreciate just how entrenched U.S. inflation has become and the magnitude of response that will likely be required from the Fed to dislodge it. Nomura's Aichi Amamiya, a U.S. economist, wrote in a research note on Tuesday, arguing the central bank will be forced to raise rates by 100 basis points at its September meeting next week to ensure price stability. Now, at the same time, other economists argue that today's environment is totally different from the early 1980s, and those believing that higher rates will tame inflation as they did back then are going to get bitterly disappointed. The only things we will achieve with such policies are a collapse in financial and housing markets and an 80s-like economic slowdown, they argue. Yesterday, Bank of America outlined that prices remain too high and stocks are still too expensive for the bear market to be over, at least according to one metric that has a perfect track record. In a note to clients, Bank of America analyst Savita Subramanian said that a return to a bull market remains unlikely. Subramanian and her team track a long list of indicators such as the Fed cutting rates, unemployment rising, or markets rallying 5% that help signal the start of a new bull market, but so far just 30% of those items have been fulfilled. Historically, 80% of the list is checked off before markets leave the bottom. For signal stocks to be due for a bull market rally once again, S&P 500 firms would have to beat earnings expectations by an average of 50%, or, in more extreme scenarios, the S&P would need to tumble more than 40% to 2,500 points, or inflation fall to 0%, they noted. Needless to say, we have a long way before we get to that point. Morgan Stanley is also bringing some more bad news for the market's future. The S&P has fallen almost 19% so far this year, but the Wall Street juggernaut forecasts it will go even lower in the next few weeks, months, and years. Our 2022, 23, 24 base case estimates are now 3%, 13%, 14% below consensus, respectively. A team of analysts led by Mike Wilson wrote this in a recent note to investors. In our base case, 2023 now marks a modest earnings contraction, minus 3% year-over-year growth, though we do not embed an economic recession in this scenario. While acknowledging the poor performance in equities year-to-date, we do not think the bear market is over if our earnings forecasts are correct. On the same note, famed investor Michael Burry agrees that markets have even further to fall. "No, we have not hit bottom yet," he tweeted. "Watch for failures, then look for the bottom. 2 SPAC ETFs failing is not near enough." In other words, the legendary investor is implying that another crash is already underway. Tuesday's losses are nothing compared to what's next. These posts are in line with Burry's usual bearish attitude for 2022. As Bloomberg noted, warnings from Burry about coming turmoil have become common on Twitter this year, with the founder of Cyan Asset Management predicting consumer spending and silliness in markets will cause trouble for investors. The seasoned market player suggests that the S&P 500 could plummet by another 53% to below 1,900 points, based on the benchmark index's bottom tick during previous crashes. Similar to Burry, Robert Kiyosaki sounded the alarm yesterday, saying that what he called the biggest bubble in world history is going to end with an equally historic meltdown. "That crash is here," he said. "Millions will be wiped out." Furthermore, veteran investor and GMO co-founder Jeremy Grantham, who cautioned about an epic super bubble across stocks, bonds, and housing, repeated his warning of an impending burst in a research note released this week. Grantham dismissed the latest rebound in stocks as a brief reprieve, arguing that previous super bubbles have always been followed by market declines of at least 50%. The legendary strategist highlighted how a painful combination of pressures spells trouble for asset prices and economic growth, pointing to shrinking corporate margins, food and energy crises, pandemic disruptions, the Russia-Ukraine conflict, and longer-term issues such as aging populations and labor shortages. Each cycle is different and unique, he added. But, he continued, every historical parallel suggests that the worst is yet to come. Another remarkable warning came from billionaire John Catsimatidis, who said that soaring interest rates will cause more harm than good, and eventually they'll push financial markets and the economy over the edge, sparking another global financial meltdown. In an interview with Fox Business, Catsimatidis urged the Fed to stop monetary tightening. "So I call upon the Federal Reserve," he said. "If we keep raising interest rates, we're gonna destroy the rest of the country. Somebody has to stand up and say it doesn't have to happen. And they're gonna destroy the rest of the country. And there is a recession. It could turn into a depression, he said. The outlook never looks so gloomy. Risks are growing and investors can feel it. We encourage you to brace yourself for a catastrophic stock market crash, because that is precisely what each and every piece of evidence is telling us to do. Thank you so much for watching. If you enjoyed this video, please give us your support by leaving a thumbs up and subscribing to our channel. And check out the latest book by economist Michael Snyder, titled 7-Year Apocalypse. In the meantime, don't forget to share your thoughts in the comments section down below, and please share this message with friends and family.